All right, everybody. Hey, welcome to Note Nation Tour, the tour of the country virtually on our virtual Note Bus. Welcome tonight, everybody. Glad you guys could join us. Tonight, we roll into the city of Angels, Hollywood, Los Angeles, California, and LA County in that neck of the woods. One of the largest markets in the country. We've spent a lot of time out there and honored to be reappearing out in LA. One of the big things that we've done I did over 10 years ago was basically hit the road and go from East Coast to West Coast. What I thought would be 30 weeks turned into 3.5, 4 years of nonstop travel, and we're excited to be doing that again virtually. Instead of waiting for everything to clear up, we thought, well, heck, we can do it in a virtual nature, connect with people who are all across the country as well, and really provide some great content and numbers to everything that's going on. So anyway, welcome to the Note Nation. If this is your first time joining the webinar with me, hey, we are recording this. You can always catch the replays by also going to our YouTube channel, WeCloseNotes.tv as well. Let's see if PowerPoint is going to work with us. Here we go. So welcome to the Nation Tour. We got local and national investors, people that invest in LA, people from LA. We have new real estate investors looking to learn more information about this. We'll be discussing statistics and numbers. We'll talk a little about the second half of the year looks like rolling into 2021. Definitely talking about future opportunities in the next 60, 90 days and beyond that. And we'll talk about where and when and how to get started for you guys that are looking for opportunities to be involved in doing some things. So who's this guy that's talking to you? Well, I'm an active real estate investor since 2002. Heavily background in the finance, mortgage, and debt market since 2004. I've purchased over $500 million in debt for my own portfolio. I'm the CEO of WeCloseNotes.com. That's where you can find all of our information out there at the website. But I've been teaching and had a passion for helping other real estate investors make big changes in their lives and do some big things since 2010. I am the host of the popular podcast, The Note Closers Show, that you can hear all across the country, actually live on one channel in Long Beach, California, where we're syndicated. But we invest all across the country, and so that's why we're doing this nationwide tour, not only to help us identify opportunities, but also help you guys as well and to find outside your home market. Austin, Texas is home for me. Hook 'em horns, but definitely a fan of sporting events all across the country. But anyway, let's dive into it. So what do the national numbers say? Now, we all know that we've got some Debbie Downers out there that can get pretty depressed by just focusing on the numbers, right? And sometimes they just make you want to scream. So, pardon us, but you can look at the numbers, and I have a tendency to like to make lemonade out of lemons. I do love lemonade. Made a career of it over the last 10 years, taking non-performing notes and turning them into performing notes. But when you look at the national unemployment rate being 11.1%, that is startling. 1 out of every 9 individuals is unemployed. Think about that. 1 out of every 9 individuals is unemployed. Total 17.8 million people are unemployed. That number is actually up a little bit compared to last month, but it's hard to say as things come and go as states tighten up. 52% of small businesses are expected to fail here before the end of the year. Small businesses, big businesses, we all know businesses are struggling out there. 10% of the homeowners here's the thing, 10% of homeowners already across the country were already struggling to stay current before everything kicked in March. Seriously, 10% of Americans are already close to that 30-day late aspect of things. And we'll show you some numbers that are pretty startling and alarming. We have, as of recently, a 7.76% national mortgage delinquency rate. That is up, has almost tripled in the last 6 months, obviously, because of the default rates, forbearances, people behind. That's not 100% accurate, though. It doesn't consider owner finance notes. It doesn't consider non-government-backed loans in some cases. There's 4.1 million Americans currently in default. Okay? 4.1 million Americans currently in default, and that number, do we think it's going to get better or get worse? I know it's going to get worse. You have people out of work, out of jobs, and the side hustles that a lot of people have done to make money over the last years, the Ubers, the delivery guys, the Amazons, all these other side hustles, Airbnbs, when those things are gone, we run into a very difficult position for people to get by. Unfortunately, I think we all can agree, Americans can't work a normal 40-hour week with minimum wage and hope to survive, especially in LA. all right? Especially in the bigger markets, that's a death sentence. If you think back to 10 years ago in 2008, which is one of the first big downturns I went through as a real estate investor, when everything started to hit the fan, it took us actually 18 months, it took a year and a half before we had 1.6 million defaults in 2008. That's right. It was almost into 2010 before we started seeing that big number. Well, that was the big thing. When everything started hitting the fan, Lehman Brothers and all these other banks failing, the real estate industry took a big dump. And we've been, the real estate industry's been great, and we don't have that issue right now. Well, there's still places that are moving, still numbers that are moving positively, but that's not the case for most of Americans. Okay, mortgage delinquencies record highest spike in 2 years by things going up. And the thing that you got to look at here too, here's the numbers behind the numbers. Non-prime loans experienced the greatest annual increase in delinquencies in June, rising 21.8%. Expanded prime loans charged the second highest increase at 12.2% rise. Reperforming loans experienced a 6.4 annual incline, while prime loan delinquencies rose 5. It's all across the board. RPLs are reperforming loans. All right. Non-prime, that's the subprime. Okay. People that bought homes without having good credit, not much down. There's been years around here with a lot of programs that were 100% financing or bad FICO scores. Those things have stopped, but it hasn't stopped the defaults. So we're going to see a repeat, if not maybe not quite as bad, but who knows, maybe as bad. They had a record surge in April. This is talking about where in the country they were really surging. New York City ranked top third in the 100 metropolitan areas. Miami was second. Las Vegas. Miami was number 2 and Las Vegas is Miami was number 1, Las Vegas is number 2. Nevada was among the states with the biggest delinquency rates, climbing 5.2% to 8. New Jersey and New York obviously are average about 5. I only show that to you because it's other parts of the country. Other big metroplexes are really getting killed right now. So is that good news or bad news for us? And I encourage you, if you're watching this, to ask questions. Feel free to type in the chat roll and ask questions. Is that good news or bad news for us as investors or people looking to invest? Well, it all depends on what you think and where you think you look. Basically, 1 out of 20 borrowers for sure is in default of some sort. Okay. California is higher than the national average in places because obviously it's a higher cost of living out there. California has a current default rate of 9.5%. Ouch! All right, 10% roughly default rate. Now you think you've longer foreclosure time frames, and I constitute a longer foreclosure time thing really anything over a year. It's a non-judicial foreclosure in California. We all know it's a cookie kind of weird thing, but to foreclose and a non-judicial foreclosure taking 480 days, it's not desirable. Commercial is not quite as long, but the thing you have to keep in mind, there's a backlog of forbearance agreements. Are you going to see stuff really hit the market in the next 6 months? It depends. Okay. That 9.5% number just came from, it was an article. I'll pull it up for you, Christopher. Literally just came across an article day. Maybe I got it pulled up here on one of the things. But it's going to be a while. It's definitely going to be a while before we start seeing foreclosures hit the market. And that's where a lot of real estate investors get into. I want to buy an REO. I want to buy a foreclosure. You're going to see some of that, but it's going to be a while based on the forbearance agreements. Okay. Definitely before agreements. And here, if you look at the housing predictions, this was a national base housing prediction that we're going to see another year of about 5% appreciation across the country. It's now we will only see a 4.5. Existing home sales year over year down 15%. Home prices on average across the country have stayed about the same. It's just that you have to keep in mind, it's a lot of people are hurting. Okay, if you look at the default rates across different things, say all loans are the 4.6 here. The conventional rates here are at 9.69 on the FHA loans. Conventional is at 3.6. VA loans at a 4.36 default rate. That you can see some of the things are really kind of hurting. The FHA loans, those have been a lot of subprime loans where people got in with nothing down. I know a guy at Bank of America. That Bank of America was offered 100% financing because they donated to the down payment. donated the 3% down for an FHA, and then they also paid up to $7,500 in closing costs. It's scary, right? Totally scary that they're basically giving a loan to somebody, we couldn't probably qualify, we get a better rate, and it's hurting. Now, if you look, I was able to pull this stuff on Realty Track recently, and this talks about some of the different foreclosure rates depending on the county you're in, all right? If you'd like to, just drop me an email at scott@weclosenotes.com. I'll be glad to send you the links to these things there for you. But you can see the color here is, and how they calculate this, the darker the blue, the higher the rate. Basically 1 in 850 housing units all the way to 1 in 23,000. Okay, so that's a big, big difference there. But you start looking at the darker counties, 90077, not sure, 90058 is the 1 in 850. All right, that gives you a bit of an idea where things are happening and where things aren't. The haves and the have-nots. You look at the distribution for homes. This is best as of May. Pre-foreclosures were up up prior month, but down prior year. It's not a really surprise. Auctions obviously were down quite a bit compared to last year because they all stopped. Bank owned stopped. All this stuff kind of stopped overnight. You can see the drop off there, March and April. Basically, boom, pre-foreclosure stopped because they're not filing it anymore. They're stopping it and suspending it. But if we're still sitting here, boom, 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 cranking along, what happens to all these people up here who were in default? Well, they're just dragging out. They're riding out. Does it mean that they're going to be more capable? You add in job loss, businesses going out of business. Is it going to be better when they decide to quit kicking the can down the road? No, it's going to be a lot worse. You can see foreclosure activity also here, total foreclosures month over month compared to 30-year interest rates. It's a different thing. The thing you got to keep in mind too is as these 4 numbers continue to retreat, as they say, they kind of pull back as people start to make mortgage payments. It's going to change. Like here in Texas, they just basically put us back in our house for 2 more months. Okay. With forbearances dropping a little bit, that's down by 57,000, say, or 0.1% from the previous week across the country. Okay. You're going to see forbearance agreements shake up a little bit, but they're not. The reason you're seeing some of these drop off is because people are like, the 90-day trial period for a lot of these other companies has stopped. They're like, hey, we got to start paying something. You look at the active forbearance plans offered by Fannie, Freddie, FHA, VA, and others, you can see that the number amount is about 5 million out there. We talked about 4.1 million people being in default. That number has grown here recently, okay? So let's talk about the commercial debt side of the game, because commercial is where a lot of people like to play in as well. We have a lot of fights taking place, and commercial rents get ugly with default waves blooming. Now, that's just not local small mom and pop. That's a lot of the big chains are shutting down. They're not paying their rent. They're not ponying up on their leases. And we're not just talking you and me, small business, talking, bigger chains, bigger companies, well-known names across the board. It's sad that they do expect 52% predicting failure in small businesses. That's where it's going to be the hurt the most. That's where you and I are going to be hit the most when you look at who's going out of business, okay? We're going to see this as an article in the New York Times talking about across the country. We're like to see more for rent signs in busy months, okay? Now let's look at some of the commercial default numbers. Across the country, 1 in 5 hotel loans are in default, okay? 1 in 5 are in default across the country, okay? 1 in 10 retail loans are in default. Retail's been on a downward spiral for the last couple of years. I think we all can agree to that, especially as more people are online. Online sales are up 26% though. Office vacancies are set to increase to almost 20% nationwide by year end. Okay, and they expect us to stay constant and get worse at vacancy rate factors for retail and restaurant space. And there's also talk about, you'll have a lot of new restaurants. Yeah, you always have that happen a little bit, but it's going to take time. I expect us to see a wave of food trucks with low overhead, low rent space popping up on a regular basis. We see a lot of that here in Texas. We are expecting the rents on commercial space to continue to fall by 10.5% by the end of the year, and also to continue to fall by another 4 to 5% next year, and maybe worse, depends on what happens. All right. Thing about office space, retail space, is so many companies that are doing online stuff that can work remotely. When you have Google and other companies paying their employees money to go get office equipment to work from home and remove that heavy overhead, that heavy burden each month, you're going to see a lot of office space fall, okay? And then you look at what's going on in the multifamily space, especially in LA there, you guys. This is a recent article, May 15th, talking about how the city is really working, and I get it, there's a no-win situation. If the city helps out the tenants, they hurt the landlords. If they help the landlords, they hurt the tenants. I get it. It's not a good thing. The most important thing on here, it provides basically charging late fees during the crisis. We understand that. It also gave the unprecedented steps that the tenants can file lawsuits against the borrower, against the landlords, okay? It forced residential tenants 12 months, okay, to repay any rent that was not paid during the COVID-19. Landlords and tenants may work out a payment plan, or doesn't apply for what happens if no agreement is reached. That's the thing that aggravates the hell out of me. You got 12 months to pay. What happens in 12 months? Well, then you can move on. Well, that's a year that I'm stuck with a deadbeat tenant, and no offense to deadbeats. That sounded weird. But people that can't pay, I get it. But look, if you can't pay, I can't pay. You know pay, you know stay. I've got a mortgage to pay. I've got underlying investments as well, too. Now, we've been very lucky. A lot of cases, multifamilies have actually performed pretty well, but down only 10 to 15 or 20. But it's going to continue to get worse the longer this stuff goes on. So where are the opportunities at? Well, are they going to be in the foreclosure REO market? No. Why is that? Because it's going to take a year or more to get through these forbearance and then go through the foreclosure process. If you're waiting for foreclosures or REOs to hit the market, I have a realtor friend who's got all excited about the fact that, oh, I'm going to get my real estate license because I made a killing in REOs 10 years ago. I'm like, well, it ain't the same way now. You might as well hold on to that license for another 2 years because you're not going to see the same type of opportunities because the courts are going to be overburdened and they're just going to keep kicking the can down. I know that Fannie and Freddie have approved 6-month forbearance agreements. They're planning to do a second forbearance agreement for 6 months. Fix and flips. Well, if you don't have the REOs or the empty properties or the foreclosures, you're not going to have a lot of fix and flips. And do you want to be in rentals? If people move in, get laid off, and now can live rent-free for 12 months? No, you don't want to do that. All right? The real opportunity in this market, where it is, and in the markets like LA, New York, a few others, the really only play that you're going to see is in the debt game opportunities right now. Even with demand being high for properties and seeing some markets still move, you're still seeing a huge amount of distressed debt. And I'll share with you a couple numbers that we pulled up recently on some of the things. Residential notes, you're going to start seeing those in the fourth quarter as people can no longer let people live for free. You can't let my borrower, if you can't pay, you got 6 months, you got to figure something out. 6 months to pivot, 9 months to pivot. You got to do something now. Otherwise, if I can't pay the bank because you can't pay me your rent, it's not a good thing. Commercial notes. We know we're going to start seeing commercial notes hitting the market. Already seeing that across the country. Hotels, office, mixed use, big box. Self-storage is doing okay. Apartments are okay, but there's going to be a wave of apartment defaults as many investors overpaid for apartments with the idea that they were going to gentrify, bring their rents up, and then in 3 years, go get a traditional loan from a bank and get refinanced out. But that's not going to happen. It would be very similar to what happened a decade ago. Same thing happened. People were overpaying for multifamily. Markets dropped when the bank became above a 70, 80% LTV. They went to the borrowers, say, hey, I need to bring another 5, 10, 20% to the table to put us back in the equity position that we need to be. When they didn't have that money, then it became defaulted. Then it became an opportunity to pick up the debt at a fraction because the banks wanted that stuff off their books. And you're going to see that happen again. Already starting to see it on some different markets, different asset classes across the country. So let's talk about some of the banks in trouble out there. There's a list that you can purchase. A company called Bauer Financial. They are a bank and credit union rating system. They're constantly looking at the bank's quarterly filings with the FDIC. And they will pull that information, and that's one thing that we track on a quarterly basis. Who's in trouble? What banks have difficulties? Who's got a ton of stuff on their books that they're looking to get rid of? Now, if you look at the Bauer Financial list, yes, it has 45 banks at about 1,500 actually have offices. Their main office is in California. That's where the corporate office is. Yes, we know there's a lot more banks in California, but it ranks banks based on where their home office is at. And so I pulled the list up and was looking at this earlier today. 45 banks are based in California. Give you some numbers. Some staggering numbers just for that. There's over 2.3 billion loans that are already 90 plus days past. They're already in default. I mean, basically, each bank averages out about 51 million per bank. Okay. When you look at it, it's got an average of about 3% of each bank's loans are 90 days past due right now. That's not a lot, but that's total loans. That's just not the residential loans, okay? There is currently 1.4 billion in single-family loans in default, okay? And you have two big parties out of the 45 that you guys, I mean, Union Bank is a big one with over 100 million in residential defaults, closer to about 105 million in residential defaults. CID Bank has 263 million in defaults, just on the residential side. Now, the way that banks start to move assets, especially non-performing notes off their books, is they start increasing their reserves. They start pulling back the money that they're lending out to keep reserves to offset their losses when they sell notes off at a discount. And we're seeing that happening all across the board, not just in California, but in New York, Florida, Texas, all across the country. These banks are pulling in reserves so they can be prepared come the fourth quarter. Many of the lending programs that they lent out, that they were doing subprime, or bigger mortgage companies that were had warehouse lines with these bigger banks. Those warehouse lines have been shut down. The banks aren't lending money to mortgage bankers to write bad loans anymore. Remember, we talked about at the beginning, 21% of the subprime loans is starting to default. Many of these bigger banks have been the bookkeeping or been the bank behind the warehouse lines for mortgage bankers for the last couple of years. And when you start seeing lenders giving 100% financing, low credit scores, it's a competitive monster where it gets more and more aggressive, and that's going to lead somebody, when the music stops, holding the bag. And Union Bank and Citibank are two of the ones that are probably the biggest in trouble right now. They may not talk about it, but everything they're reporting shows that they're on that precipice. Maybe have already gone beyond it. So why buy, or why should we be interested in distressed debt? Well, that's the closest you are to the source. That's, as a real estate investor, you're the closest to the source. You get the best deals. You're also not having to fight as so many people out there. You can start purchasing debt today. If a bank, lending institution has non-performing notes, they can move it, and you can move it today. You don't have to wait around 6 months or 12 months to foreclose. If you're buying the note at a big discount, right, you've got a lot of opportunity. All right. Now, obviously, the discount's going to vary by the discounts of significant discounts depending on location, foreclosure, timeframes, values, conditions, etc. You purchase the debt, and by then becoming the bank, you can buy this debt at huge discounts, 30 to 70%, depending on what's going on, where it's located. Maybe you want to buy in LA. Maybe you don't want to buy in LA. Maybe for what you can buy a note in LA, you can buy a neighborhood in Ohio. All right. The biggest thing is the banks always win, and you've got a variety of strategies being a note investor. You can make money without actually having to do any toilets and tenants, without having to deal with any landlords, or without tenants. The person doesn't call Bank of America when the toilet gets clogged. Okay, no toilet stands and trash outs. Usually, one of the best plays is to get the loan reinstatement and offering up the bars. Yes, a forbearance agreement works great when you buy the loan at 50 cents on the dollar, not when you originated the note. So that's the thing to keep in mind. Modifications of big opportunities, short sale, people want to leave. Short payoffs, people want to stay in their house, and you can take a discount off what's owed, but it's way above what you paid. Great. Foreclosure is obviously going to happen. Loan sale, selling the note to another investor. Deed in lieu, cash for keys to the borrower. Hey, we'll give you some money to walk. It makes sense. We do a lot of these on a monthly basis. forbearance agreements, loan modification, deed in lieu. I had to borrow some of the property and walk away. They got some equity, but they're like, want to walk away. They're just done. I'm like, okay, great. And that's the goal. Take over the note, keep them in the property if you can, or turn it into a cash flow asset of some sort, or keep it as a performing if they're going to stay and start paying. There's a lot of great opportunities. You can do what you want once you've taken that property back. Like with the borrower that signed the property over to us today in Kansas, it's an REO now. I can do whatever I want. I can sell it. I can turn around and rent it. I can turn around, owner finance it, fix it up a little bit. I'm now the owner of that property. I don't mind owning real estate. Most banks, though, don't want to own real estate. That's why they keep kicking the can. They don't want to go through the foreclosure process. And they would rather sell the debt to you and me at a bigger discount and let us deal with the issues. Well, if we bought it at 50 cents, it gives us a lot of flexibility to work with the homeowners. Some other advantages of note investing. We're not one of those type of strategies where you're sending out postcards, yellow letters, no direct mail costs. We don't mail letters out. That's just a waste of time. I mean, unfortunately, direct mail gets 1 to 4% response rate. I don't want to do that. I want to drop money in there. If you've got an email address and can send emails through like a MailChimp, great. LinkedIn, you can reach out to asset managers directly on LinkedIn to get deals sent to you. Or pick up the phone and dial for dollars from some of these banks off of our financial lane guide. That's really the biggest keys. You don't have to have a fancy postcard, fancy yellow letter, bandit signs. The beautiful thing that I love about note investing is if I get a hold of a bank, it's not for just one deal. It's for regular deal flow. Yes, maybe this week they only have one note. Maybe next week they got 10. Maybe next quarter they've got 100. There are some sources that I get lists from on a quarterly basis. I've been getting deals from them for years. Most real estate investors, though, they go through the fact, I get a bandit side to get one lead. Maybe I need to lead it. Direct mail, I got to mail out 1,000 postcards to get 40 phone calls to maybe get one lead out of that. That's the thing that always made my mind go when I see other investors. I got plenty of other real estate investor friends spending $5 grand, 10 grand, 15 grand in marketing to get one deal. Oh, that kills me. All right. And this is the thing too. You can cherry pick the best deals for your portfolio. If you get a portfolio in from a bank, a lender, you can cherry pick. If there's something you don't like, you don't have to buy it all. Buy what you want, say no, move on to the next one. You're going to get better deals with bulk pricing, obviously, if you can pull some investors together, take some down, or if you got capital yourself. Like I said, we've had a lot of people over the years that are coming from LA, selling their house, moving to Texas or other places, and now they got $500,000, $1 million in cash to play with. Hey, it's not a bad strategy. Self-fund your stuff. But if you don't have money for yourself, there's a lot of other investors out there. And yes, you can buy residential commercial properties by buying the debt first and then taking the property back. One of the best capital raising strategies, most of these note companies, most of these investment firms aren't using their own funds. They're raising capital from other investors to fund purchases. And a lot of people ask me, you have to think about that. Well, Scott, are we going to get crazy? Like, yeah, there were 15 million homeowners underwater in 2010. 15 million. We're at 4 already. We're going to have a lot more before this thing is said and done in the next year. So are there investors out there? Yes, 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 yes. There are a ton of investors out there. There's $9 trillion in retirement funds out there right now, just sitting there in retirement funds, waiting to be things, okay? There are 115,000 investors in Los Angeles with an IRA, and out of that number, 80,000 of them have at least 150 grand or more in their accounts. Yeah. 80,000 people have at least 150 grand or more in their accounts. I didn't even think about running the numbers on that. How do I find those numbers? I've got my sources. It's different per county across the country, but I have my sources. It taps into Texas. 1 to 2 to the 10th power. That's what, $1.2 billion, something like that. Maybe a lot more. No, it's more than that. 80,000, 3. Yeah, I guess it is almost $2 billion. 9, I don't know why that's not right. I forgot to type that in there. There are actually, I could give you a specific number. Hang on here. There are exactly in LA 95,000 real estate investors. 95,000 real estate investors. Not in New well, I had that number right. That's what happens when you replicate a PowerPoint. But anyway, there are 95,000 real estate investors just in Los Angeles alone. So do you think here? Do you think there's enough investors out there to find your money and enough other deals that you could flip some deals to? investors looking for deals. Yeah, we know LA is a competitive market, always has been. And you have a cutthroat thing where people get creative and overpay and overpay and overpay. You know, I know a lot of people that slice their own grandmother's throat for a 4 cap or greater in LA. 3 cap, they might cut their own wife or husband, okay? The idea in this is that you don't have to settle for skinny deals. Do you want to be the banker or the borrower? And in every case, the bank is always going to win. And that's one of the biggest things that we have a great opportunity, like we did 12 years ago, 10 years ago, 5 years ago even, that if you weren't buying debt, you were probably overpaying for property. So how do you tap into the tsunami of good deals? I've been teaching investors all across the country for the last 10 years on how to buy non-performing notes. That's what we call our company, We Close Notes. So I'm known as the note guy across the country. Thousands of investors purchase their first non-performing note. It can be done. Banks, lending institutions, note sale platforms, residential, commercial deals. There's a lot of students that we've had, a lot of investors have made a lot of money from when we teach. We've made a lot of money as well. And a lot of them either go for the fact that they are looking for cash flow with performing or reperforming, or asset growth. If you've got a portfolio, we've got it. You know, people have a portfolio of rentals. Okay, they're using notes to take back the property, either turn them into reperforming notes or they add them to the rental portfolio in specific parts of the country. Okay, you can buy one-offs, or if you want to, you can buy in bulk if you want to raise more capital. And no, you don't need to have $1 million to start taking down deals. It depends on where they are in the country. Okay, we've seen trades anywhere from 25,000 up to 5 million. Actually, the cheapest I ever paid for a note was $7 for a note in Baltimore that I sold it for $5,000 2 days later. The average trade that we were making is somewhere around $250,000 to $500,000. It depends on what we're buying and where we're buying. Have we bought some big trades? Yeah, we bought some big trades. 175 assets in our biggest trade, and one being the smallest. All right. The bank doesn't care what your credit looks like. They're not financing you on these. They want to know that A, you've got the vendors and the team in place, which is pretty easy to put. And they don't care where the funds are coming from. They're not requiring earnest money down. Usually not requiring deposits. They just want to see the money show up in their bank account as a wire. And so there's a lot of other people's money out there that you can tap into. And like I said, if you can jump on LinkedIn, you can send an email blast or make a phone call, you can dive in this business very simple using those couple tools. We spend a lot of time on LinkedIn tracking down special asset managers at bank, whole loan traders, secondary marketing professionals. Okay, connecting with them. I had 2 of them wish me a happy birthday or congratulations on my work anniversary, and I just followed back up. Oh, hey, do you have? Oh, we sure do have something. Or you jump on Bauer Financial and look at the numbers on there. Look at the bank rank systems. So they're ranked a 1-star now, or we're a 5-star quarter ago, but they've dropped down to a 4-star or a 3-star. There's so many ways to find deals out there. You just gotta know where to look, and that's where we've done. So, whatever your focus is, whether you're like single-family homes, great. If you like mobile homes, duplexes, triplexes, fourplexes, whatever, great. If you like multifamily and apartments, great, you can find those. You want looking for hotels. I got a buddy of mine, Garrison Gilbert out of Maryland, who is converting a 65-unit hotel that went under because of this into 44 2-bedroom apartments. He's totally regentrifying the asset, got it as a steal, and doing an amazing thing. If you're looking for retail or office space, God knows that's going to be cheap. Okay, self-storage is also popular. Heck, there's a lot of people that I know that are taking larger big box stores or old grocery stores and turning them into self-storage facilities because it's easy to do. Mobile home parks, if you're looking for that asset class, I know California might be a little expensive, but as you get further out away from LA, you may be able to find some of this stuff. Great cash flow, great assets. Look, there are going to be deals, and there already are currently deals in all asset classes. You just got to know where to look and put some work in. But the biggest thing I want you guys to keep and realize is it's not just about you. It works best in this industry when you're creating win, win, and win to the third power scenarios and stories. Win for you, obviously, because you're making great money and your investors. Win for the borrowers because you're able to keep them their property, modifying, forbearance. And a win for the banks because they get it off their books, and it gives you the opportunity to be creative and really help people out. One of my favorite stories is about Sheila and her husband, William, out of South Beloit, Illinois. They lived in this house for over 18 years, raised their 3 children. Unfortunately, Will had a heart attack, if I remember correctly, health issues. They took out a loan on the house before he got sick when the values had gone up. And what happened? The market crashed. So they were upside down by 50%, and couldn't pay their mortgage. They couldn't pay the year, but they were behind on, actually it was 4 years they were behind on because they've been trying to do a loan mod for 4 years. And so when we bought the note, we bought it at a substantial discount. We were able to negotiate with her on the phone immediately. And basically in the first year, I got my entire investment back. And how we structured the deal, she'd have the house paid off in 6 years. She just finished paying the house off just a few months ago. And it's a beautiful thing when you can keep somebody in their house that they've grown up with for 18, 20 years, house they want to retire. They put their love, their blood, and their sweat into a house. I don't know about you guys, but the last 90 days, I've had to work from home and doing a lot more honeydew projects. Our garden looks nice. Our backyard looks like a rainforest. We've got vegetables growing. We got flowers. You know, it's become a place that is really, is your castle. And you don't want to give up your castle no matter what bad things. And we all know shitty things happen out there. We've in a bad environment right now. And you really want to try to help people stay in their houses and do some good and make some money doing it. This is the strategy for you. Okay, you can do it big or do it small. It's up to you. Our buddy Gene here from Elkhart, Indiana, has done an amazing job. When I first met him, he was working in his own company, running as a hot shot all across Indiana, buying a property, fixing up here in the north part of Indiana. I got a great text message from him the other day talking about how now he's bought 175 assets. He's got about 13 billion. He's got a fund started. Never thought retirement would look like this. And he's done an amazing job. And we're so proud of Gene out there. And he got to start later on, a little later in life than most people. Laura Blunt, a rock star, just moved to her dream home in Maryland, lived here in South Texas, or south of Austin, and moved back to the house that she's been wanting to buy her entire life. But she's also gone from buying one or two deals, trying to wholesale, trying to do some light flips and get a real estate hustle on, to being a full-time note investor. I think she's closed on over 120 notes. Getting ready to close on a 148 loan portfolio right now for $4 million, and just doing an amazing job. Changed her life, changed the outlook of her family, and just absolutely doing amazing things. Then you want to roll into our buddy Keith Collins out of Ohio. He sends me a email the other day talking about how the strategies that he's learned from me, him and his wife have made over $1 million in the last 12 months in buying debt. Not just in their backyard, but across the country. And I'm so proud of him. He's never going to retire, as you like to say. He's previous mayor of a city outside of Cincinnati. His main thing was putting in water districts and sewage treatment plants. But now he's a full-time note investor doing some amazing things, and we're so proud of him. But if you want to talk about age, yeah, those three are a little bit more seasoned, but you got people of all ages out there. And one of our most recent coaching students, Rafael Huerta, San Diego, he's one of those guys in America that have been hit hard. Had a car detailing business in San Diego, very successful doing that. But when people aren't driving and people are staying home, they sure as heck aren't paying to wash their cars. They're not going to pay somebody to do it when they can do it themselves. His business has been almost completely wiped out. It's a sad thing. The 15 employees he's had, basically, they don't have a job. What's Ralph done? Well, he started learning about the note business. Didn't have any real estate background. Didn't know a lot of things about real estate, but he has learned. He's been his own best student. And he's taken some classes from us. And I'm very proud that in his first 30 days as a note investor, he went out and bought 5 assets. 2 of them he got reperforming at over a 20% cash and cash return. The other 3 that he's bought, he's in the process of selling right now, making a profit on them. Yeah, he's used his own money, but he's also, by just word of mouth, raised over $100,000 from his friends and family to help him move some, buy more assets. And he is hooked. He's like, Scott, this is the best thing could have happened. Yeah, I get it. Would have liked to keep my employees as best I could, but life is what it is. So he feels a whole lot better than he did when everything first went down. We've got people of all ages, all backgrounds, all colors. I don't care if you're a guy, girl, white, black, Hispanic. Don't care what your age is. I don't care what you've been through. You've been through the big D and don't mean Dallas. You've been laid off, whatever. If you want to learn the note business, you can do so, and there's never been a better time. And a lot of people like to make it a lot more complicated. Yes, it's similar to The Big Short if you like to watch movies, but there's a lot easier way to do things. And the big thing I'm so proud of is all the students that we have helped take their businesses to the next level all across the country of all experiences. And a lot of them got their start by learning basics from me. Most of them did anyway. And one of the things that we have done and put together for this special time in America is a one-day class called our Note Weekend class. And what it is, it's me teaching 9 a.m. to roughly 3, 4 o'clock in the afternoon on the basics. If you go to noteweekend.com, you can actually see the full, basically, lineup of the schedule. You get me talking. It's not a pitch fest. I don't bring in 40 speakers. It's not watching videos. It's me teaching. You get a 20-page manual along with it. And we really focus on a variety of things. It's I call it a mini workshop because it's not a 3-day workshop. It's, it's a full day there for you. We live stream it via Zoom like here. You ask questions. We take a little break here and there. And then on Sunday, you get the replays. We restream the replays back to you. You also can watch the replays at your own speed if you don't want to spend Sunday in front of a computer. Watch them at your own. You can download them, take them with you on your laptop or iPod. If you want to sit outside in the pool, your desk, or wherever, you can take the replays with you. It's called basically our Cliff Notes of Note Investing. A lot of our students in the past have come through that back. So this is great, Scott. This is a great refresher. Kept me rocking and rolling. Is also a great starting point. It allows for you guys to dip your toes in the water to see this is something that would be valuable for you. And no, it's not $500, although we are giving over $500 in value on this with the replays, the notes, the lists, the things like that we go through. Normally $99, we're dropping it down just to $49 for you guys. So it's over $50 off. Got to register before the next one. Next class is July 25th, so you need to register before July 24th. Love for you guys to take advantage of it right now. If you guys are registering for it this evening, I can actually send you the replays to the most previous one that you have, so you can actually get a head start and absorb it even more. Can't make the July 25th class? Hey, you can make the August 29th class. Is also Saturday. So noteweekend.com, like I said, what will we cover? First part of the day is all about how and where to find the notes. I talk about how do you build lists? Where do you find these lists at? Where do you find the people that are the decision makers to say yes to your bids versus no, we don't sell notes. We'll talk to you a little bit about raising private capital. You're not going to learn the note business in one day. I'll tell you that. That's why we have a bigger 3-day class. But I will tell you, you're going to learn a lot about what you can and cannot do and some of the tools that you could use. And we've got other videos along with our 14, 15 sessions throughout the day that we actually let you watch as well. We'll talk about the different exit strategies to help you make cash. All right, we all want to make money, especially now more so than others. So we'll go through that. We'll talk about the different vendors, the team members that you'll need to bring on as you're buying notes, people to work with that are great in helping you not only buy notes in your backyard, but help you buy notes and find the right deals and do the due diligence from all across the country. We'll talk about some different loan trading platforms, and we'll cover a whole lot more than that. But literally, it's me for 9 hours, basically 9 a.m. to roughly 3, 4 o'clock in the afternoon. Sometimes we'll go to 5. Depends on the questions, depends how big the class is. But I would love to have you guys be my guest at noteweekend.com just for $49, guys. Trust me, if you go through the first hour, realize, hey, this is not for me, I'm gladly refunded back at no questions asked. So love to have you guys be a part of it once again. 1-day online note training. It's on Saturday, July 25th. We're streaming on Sunday. The Cliff Notes of Note Investing. Once again, if you go to noteweekend.com and get signed up, we would love to have you be a part of that. Now, any questions from those that are out there, whether you're watching this on Zoom or catching this on the live stream, love to have you guys comment. As always, if you are watching this in the live stream, feel free to comment. Or if you'd like to also schedule a quick phone call, you can by going to talkwithscottcarson.com and scheduling a 30-minute phone call with me there. So Alfred, Arthur, Christopher, Irene, Joe, Corey, Lynn, Vanessa, Wayne, Maria, there's other people online I can see. What questions do you guys have about Note Weekend? I think, Wayne, you've been through this once or twice before and had a good time. Some of the others, I don't recognize the names. But anyway, what questions do you have regarding the note business, the markets, that kind of stuff? Christopher asked the question, what level of investment is needed to start? That's a great question, Christopher, so I don't know your background. Usually, when I got started, I didn't have any money. I had to basically hustle, and one of the things that we teach is that when you're buying notes, there are expenses in workout, foreclosure costs, things like that. If you're buying right, you can often have your investor end up funding that extra amount into the purchase. So say you're buying a note for 20 grand, they fund it at 27, that's still at, say, 50 cents on the dollar. You've got that 7 grand to work through, okay? But that's the thing. You are going to have some marketing costs along the way if you want to take it to the next level. Yeah, you can have the free account on LinkedIn. You're going to need an email campaign system. MailChimp, you can do up to 2,000 contacts for free, but you're easily going to run over 2,000 contacts pretty rapidly. So it's always say to have some money there. yeah, I don't know, 5, 10 grand in marketing costs for the first couple months as you're rock and rolling thing. This is not a, I'll tell you this right now, this is not a get rich quick scheme at all. This is a build wealth and it takes time. Gene didn't get to his 100 plus assets in the first year. He did it in his third year. But the point is he bought several, made 20 grand, 30 grand, got a re-performing note at $1,000. My biggest goal as anybody ever comes through my education is to give you enough tools to go out and immediately start doing things. Does that make sense, Chris? It also depends on the market. If you're in LA, you're probably going to need a little bit more startup money. If you're buying in other states, other cities, you can get a little bit cheaper for some things. It also depends on your resources and your level of experience out there. So it's a different question for everybody, but that's the best answer I could probably give you. But great question. Thanks for asking that. Thanks, Vanessa. Appreciate it. So any other questions, concerns? Love to have you guys take a part of it. Like I said, it's July 25th up there. So basically, under 3 weeks out. We used to have a pretty good time on that. I'd love to have you guys be a part of it. Like I said, it's a way for you to dip your toe in the water, get a feel for it. If it's not for you, hey, you didn't invest a lot. It's not just a high-end stuff. We go through a lot of great information in there. And I will tell you this, I've had people tell me we cover a lot more in our one day than the other educators do in a 3-day workshop. I'm a big believer in giving you the pickaxes and the tools to go and really find that pot of gold out there for you. All right. Well, there's no other questions or comments. I'd love for you guys, like I said, check it out, noteweekend.com. You can go there, get signed up for it. You'll get a link from me, usually in 24 hours, to be able to start tapping, start learning. We actually always revamp the manual, actually. So it's a good outline for you. But you can see the schedule we discuss at noteweekend.com. Just scroll down a little bit. What we update, I'm updating the manual for this with some new video links, some new infographics, some new companies and stuff like that, to make it very valuable for you guys. And also, if you do decide that you want to sign up for one of my future 3-day workshops for my online home study course, we credit that $49 towards that tuition. So hey, you want to expand it? Great. You didn't lose out on anything. You got as a credit towards future classes. So hopefully that was valuable for you all in the LA market. Any questions? If there's not any questions, let me do this. I'm here to help everybody. Like I said, I'm here. I want to find success. I got a goal to help educate 10,000 note investors between now and this time next year and the next year. And one of the ways we want to do it is by getting the word out and helping them realize, hey, note investing is not as difficult as you think it is. Okay. Christopher, thank you for your time, bud. Best of luck to you all. But you know, that's one of the easiest things is our training. We've been told this by many people. We make it easy for you to understand. We make it fun, and we're not going to blow smoke up your ass. I don't want to waste your time or money. I want to deal with people because we're going to see, like I said, another tsunami of deal flow coming in. I want to have the people in place that are hungry and looking for deals that we can get out to them. So that's it, everybody. I want to wish you all a safe and pleasant evening. Hopefully you all had a great 4th of July weekend and your week is off to a roaring start. And we look hopefully forward to seeing you at the next Note Weekend here, July 25th. Noteweekend.com, everybody. Once again, noteweekend.com. Be safe, and we'll see you all at the top.